Thank you. Yaron, thank you for your short introduction. I'd like to invite now Gary and Rex to join the panel. So you have the butcher and everybody all together. I'd like to open the panel for questions to the public as soon as I can, but let me start.
I have a rebuttal.
Rebuttal?
A rebuttal to what Rex said.
Okay.
Well, actually, two things that I just with respect to what Rex said, and he's very good. I knew he was that Raymond James is a great bank, but he's very good.
I have my hand on my wallet at the moment.
When Rex said that when you don't hit your earnings, the price falls 40%, you also get sued. So in case that isn't enough. Now, there's a good thing and a bad thing about that, because if you're well counseled, somebody has urged you to buy D&O insurance and has read the policy and has made sure that you're going to be protected. The other thing is that the people who are bringing the lawsuit are not Greenpeace. They are not bringing the lawsuit because they want to save the world. They are bringing the lawsuit because they want access to the D&O policy, and you can make it go away. The other thing, as Yaron pointed out, that you all know and love your accountants. There is no closer relationship outside a marital relationship than you and your accountant. But you should understand that once you start thinking about going public, there is another accountant, another woman, another man who comes on the scene, and that is the SEC accountant, and they are evil. They have no relationship with you. They don't care that the accountant that you've been paying for the last 8 years has been telling you to do it this way. They will tell you to do it a different way, and they will tell you to restate your financials. So you need to talk to your accountants about getting the SEC partner to look at the financials when you start thinking about going public. And finally, and I think Rex touched on this, is there is an increasing tendency to go a dual process. Perhaps the best way to get yourself bought is to commence the registration process for two reasons. Number one, if you are going to complete an IPO, you are going to be adequately funded and become a competitor and be out there. Number two, people rely on the information you put into a registration statement because there's associated liability, so they take it seriously. Whereas if you just put out a book, here I'm selling myself, here's how great I am, they don't take it quite so seriously. And we've seen a number of times, Basim was sold to Broadcom out of registration. Wintegra, has Wintegra been sold yet? No. They are rumored to be selling to PMC Sierra, but who knows what rumors are. There you go.
Thank you for your remarks. I'd like to start with the first question to the panel and then come to you. Not many Israeli companies will be able to go public within the next 12 months. I can tell you that. Usually smaller companies, we don't mature many IPOs a year here in Israel. What would be, in your eyes, the minimum requirements for an Israeli company to even start considering that process? Who should approach the process? What are the minimum requirements, more or less? I know it's individual, whatever, but what would be the minimum requirements, generally speaking, for an Israeli company who seeks that avenue?
That's yours.
Okay, so I would say minimum is going to be $50 million in run rate revenues. Again, one thing that you should know, which is a big advantage in Israel, and Gary touched on it, is that you have a structural tax advantage in Israel, and the public markets actually gives you credit for that. They don't tax affect your earnings. So I think $50 million in revenues, and I think, again, conventional wisdom would say it needs to be $300 million post-money market capitalization. It's possible because in the IPO market that existed in the 90s, companies used to be able to go public around 200, 250 or less. So 50 million in revenues and be able to engineer a market capitalization based on a multiple of earnings of, let's say, between $200 to $300 million at a minimum. Can I comment on
I just think the bar, if you would put the entry bar, or what you said conventional wisdom is, I think Israeli companies need to pass a higher bar than a U.S. company. So let's say the minimum was here 80, I would say 100 would be a number. And the reason I say that, historically, no matter, Israelis always came at the very minimum of where the bar was. And the last wave was, I think, 2007, and the performance of Israeli IPOs was terrible. And we can't afford to continue that. So we need to make sure that these companies are patient enough, and the investors are patient enough to wait till they pass the bar and some, to make sure that there's successful post-IPO performance.
Yeah, and I think Rex made an extraordinarily important point. Some of the people, the sponsors of the companies, the people who've been in the companies for 4 or 5 years and are getting impatient and are not prepared to wait for the cycle the Aaron is discussing, sometimes will force a company to get itself sold so that they can, and this is something that you need to think about as you are choosing your partners. Some bankers have longer horizons, some investors have longer horizons. Also, I would tell you that we are talking about, again, the most legitimate way of doing this, winding up on NASDAQ with an IPO. There will be people who sell you alternatives to going public with much lower thresholds. For a little while, people talked very enthusiastically about AIM. People no longer talk very enthusiastically about AIM because it turned out to be one last venture round and locked-in prices that were. The Toronto is pushing very hard and say they can do smaller deals, and of course the Tel Aviv Stock Exchange will take companies public with much lower thresholds. So, but those aren't the kind of transactions that I think we're here to talk about tonight.
Is this the only parameter? I mean, sales? Would you provide other prerequisites for Israeli companies who would like to go public? It's only, I mean, you reach the sales number and that's it? You're eligible to go the process?
Well, no, I think it's a yardstick. There's a whole variety of things that go into it, but at the end of the day, sales are going to drive profits, and usually for good companies, it might be a 20% margin or so. So I use that as kind of a yardstick and as a barometer. I mean, certainly you have to have a full management team. There can't be holes in that. You want to have a team that oftentimes somebody will get thrown in like a CFO at the last minute. I'm not a big fan of that. I think you want to have a CFO that understands the numbers and has been with the company more so than the guy that's window dressed to take a company public, because he can't possibly understand the predictability of a business if he or she has been there for 2 months. So, and then certainly I think we have to have, it can't be that the growth of the company is predicated upon a new product that hasn't been proven. So I think you're going to want to see commercial traction for something that represents a potentially big important component of the projections, and that the business model is proven. In other words, if you're doing 35% gross margins and you're projecting that you're going to do 65 predicated on a bunch of new things, I think the investors are going to want to see a little bit more of lining up of the dots. But from a yardstick standpoint, I think you can look to sales, profits, and market cap to kind of tell you where are you in the zip code, but there's a whole variety of factors. Sure.
I think you're also going to need a forecast that is convincing, that shows a, 15-20% compounded annual growth rate?
Yeah, I think the expectation for an emerging company is you should be able to grow at a faster rate than that of the overall industry. So for the larger companies, and mainly these are the ones that come from the LBO firms in the U.S., they don't grow much. They grow 5 to 10% a year. It seems to me an emerging technology company should be able to grow at a rate of 20% plus for the next several years.
And the other thing is the steak and sizzle. I mean, you need a proven, very predictable model, and then there's the here's what we're going to take your money and do with it, and then the slope is going to go up. And that's a very important thing, again, and the bankers play an important role in telling you when in the business cycle is the appropriate time. If you think you're going from here to here over 5 years, you don't want to go public at the very beginning before you've proven the concept, and you don't want to go public at the end when you've already pretty much exhausted your explosive growth. You're going to want to go public somewhere in the middle where you can promise a meteoric rise and convincingly promise a meteoric rise.
Good point. I'd like to open the questions, please, over there.
I want to apologize for asking about M&A.
No, it's a good question.
The scenario in which a smaller company acquires a bigger company, question is how something like that happens?
Actually, the only reason Aladdin as a small company could have acquired a larger company was the fact that we went public just a year ago, a year before we did that, and we had the currency to do it. As a public company, we had our shares that were traded at a certain value that enabled us actually to buy another private company that was smaller than Aladdin. So one of the great reasons for us to go public was the fact that we could later use the currency of our... we paid for a company double our size, we paid with about 30% of our stock. So we tripled eventually the size of Aladdin. We paid 1/3 of the outstanding shares. It was a great combination for Aladdin, and basically that was what enabled us to do the deal later on.
Yeah, I represented Chaim Katzman when he Equity One, which Israelis think of it as an Israeli company and Americans think of it as an American company. But the fact that Chaim owns it, I guess, makes it Israeli. But Equity One bought a IRT Realty, which was significantly larger. But the growth curve of Equity One was significantly higher. The multiple being attached to the Equity One stock was higher. The larger company was going nowhere. And that happens fairly. I've done it with regional railroads as well. It really doesn't make any difference once you're public and you can use stock and issue stock for an acquisition. If the synergies make sense and the acquisition is going to increase the earnings per share and you can show it, you can do it.
Yeah, well, I'd like to make sure that you don't have to be a public company to do it. In many cases, you see larger companies who divest business they don't really see strategic at that point, and then smaller companies get to buy the non-interesting business for the large companies, the invested businesses. You see that happening a lot, and you see a lot of opportunities created like that. Please.
I think what we heard from the panel, which was terrific speakers, is a set of impossible requirements for an Israeli company. You want to have it all. And on top of it, there's a stake and it sizzles and it grows and you earn cash and profitability 15%. I mean, for 99% of the companies, that's an impossible situation. So you guys are looking for business at the wrong place if you represent NASDAQ. Now, what I would like to hear, and I am a retired CEO of a NASDAQ company that I keep public, but some other alternatives, like the PXV, I know A maybe has a bad smell to it, what happened in the Far East, there must be some easier places to go public and get some money, maybe not the best, maybe not the grainier prestige that comes with a national company, but something else.
Before I'll ask the distinguished panel to go to the alternatives and address that issue, I'd like to sharpen the point that you have just made, because you made a very valid point, and I was trying to allude to that even earlier. Not many Israeli companies are ready to get public this year, given what is demanded over here. I must admit that. The point is that we have two paradigms in Israel. One paradigm of the innovators, not so organized, inventors, agile, whatever. And we look at our models at the Facebooks of the world. I hear a lot of young entrepreneurs. They come to me and say, yes, I don't have a business model yet, but also Facebook didn't have a business model. I don't have, but also that one didn't have. So we allude to big stories of innovation, and what we are hearing here on the panel is that you should be selling profitable, organized, good board, good people, good advisors. So this is a totally different paradigm. So can we somehow make these two paradigms closer, or can't we?
Not every company should go public. Not every company can go public. If you are not going to be able to hit the thresholds that we're talking about, and you're going to miss them by a wide margin, and you're never going to be able to hit them, then you need to start going to Ayla's next seminar, which is going to deal with, I'm never going to be a NASDAQ company. What are my alternatives for funding and achieving liquidity? And there are paths in that direction. There are early sales. There is you can develop your technology and try to license it and sell it to a different Israeli company, or you can raise venture capital money and seek to sell the company as soon as it becomes saleable and can return a profit to its investors. And you can use, there are penny stocks out there. You can go, there are, and to my great regret, we represent some of them. There are underwriters that will do $5 million deals, and they will take warrants, and they will, and you will become a penny stock. And some, I think MCI was a penny stock at one point. There are some that overcome humble beginnings and eventually wound up being a penny stock again. There are some companies that overcome humble beginnings. You're asking us to address a question that wasn't on the agenda. And of course, there are ways to have profitable companies that aren't public. Yeah.
I think you said something about there are two different agendas that we need to look at, which is one is the golden exit for all Israelis, right? There's a hamaka gdola, sorry. And then the other one is financing. There's two very different questions. And I think the question, if you want to get liquidity and then there's different options and different ideas. I don't know if these markets are good ways to get liquidity and get money off the table. That's one discussion. If it's a financing discussion, I think all alternatives that you talk about, I think are terrible, because they're more liability than anything else. The ability to raise money after that becomes impossible. And I think we need, again, it goes back to being patient and trying to look at financing and doing it at a different stage. Israel needs to introduce growth capital, needs to come and say there's going to be venture, and after that there's going to be a round of $30 million that a growth investor is going to come in, and it's going to take time. And after that we'll go public as a proper company. And if we introduce patience and we let the growth capital come in, based on that, I think we have a great future. And it's not going to happen this year. It's going to happen in a few years from now. But I think it's all a question of finance. If you want financing, I talked to Bob. I asked him about the question about a company called Viringo. Do you guys know Viringo? Mm-hmm. John Medved was a great venture capitalist, became an entrepreneur, raised the financing was what, 10 pre, 12 pre on, something like that. He's now a public company. It's worth nothing. Its ability, he's completely exposed. He's now liable to a lot of investors and a lot of people. It wasn't a good move. It's not. It's a bad move.
It was an embarrassment. And actually, we've had this experience where people come to us and say, I need $10 million. I can get $10 million going public one of these alternative ways. And I always tell them that if they have no other way to get a transfusion, and they truly are at death's door, yes, but they need to understand that once you're public, it is almost impossible to escape the market cap. The market, I'm going to give you a statistic you need to think about. The market cap of AIM, the entire AIM, all of the companies on AIM, the market capitalization is less than the money raised in IPOs on AIM. That means you are pretty much walking in there. Now, if that's the last $6 million you need to get where you're going, then take it and try to delist as soon as you can. But understand, your stock is going to trade down, you're not going to have liquidity, and you're never going to be able to raise money at a higher valuation until you get out of there.
Who wants to get public? Raise your hand. If you want to go public.
Who wouldn't want?
Who wouldn't want, huh?
Who wouldn't want to go public?
Please, over there.
Yeah. One thing that I try to understand. What's the wrong with Tel Aviv? I mean, it seems to me that the thresholds are lower. The Israeli ACC is definitely not as evil as the U.S. one.
It's getting in that direction.
I will tell you, in Israel you can pay.
You can talk to them.
It's the Israeli hell. You know the joke about the Israeli hell. Yeah.
Life post-IPO seems to me as easier in Tel Aviv.
Mm-hmm.
Well, if you're not thinking about being $300 million market cap, maybe it's still such a good deal.
What's wrong with Tel Aviv? The first thing that came to mind is the traffic. I mean, that's. Oh, it's much worse here.
Yeah. So,
Please, Yaron.
yeah, I can comment. I mean, nothing wrong with the Tel Aviv Stock Exchange, of course, but first of all, about the comment of the Israeli CC, we see a trend over the past years. If public companies used to get comments by phone or 3-4 comments by a one-pager, the comment process is becoming a lot more like in the U.S. So there's a lot more scrutiny around that, and also about controls. So Israeli SOX, like you probably know, is not 404, it's not SOX, it's what we call in the slang language, iSOX is actually SOX Lite. It deals with some of the controls, so you get that ease, relative ease. I think the others could share, but I think it would have to do with your long-term prospects and how the market would basically, for instance, if you go into a strategy of M&A as a means of growing, how much market premium would that give you? As getting to what Yankee said, as a currency for buying stocks. So perhaps Tel Aviv would be less, but I think it's definitely an alternative. You take the pros and cons. You definitely have the other risks and the other burden, like controls and like litigation risks that were mentioned before. So
you're saying it's becoming even more complicated here. If I may, Ed, you have a comment? A question? But you know what? Just a second, please. I'd like to invite Ed over here because he has a comment or a question, but we can use his experience. Come on. Yes, why don't you come over here? Help me over here.
While he's coming here, I would just point out that in two instances, we have been approached by companies listed on the Tel Aviv Stock Exchange to introduce them to bankers who will take them public on NASDAQ. And in both cases, one of the major hurdles to overcome was the fact that the valuation that they get on the Tel Aviv Stock Exchange is not the same valuation that will be afforded to it on NASDAQ. There is some market imperfections, or at least market disparities, and it's very hard to take a company that's trading at 32 on the Tel Aviv Stock Exchange and explain to investors that it's worth 6, or vice versa. So there are some significant disparities on the valuation for reasons that I don't fully understand.
It's a good point. Everybody knows Ed, so...
You do? Hope you don't all know me that well. Anyway, I was going to actually ask a question, and somehow or other I found myself stuck up here.
Well, you're responsible for me being here, so you deserve it.
How does anybody have statistics on the number of companies having gone public then go private? Does anybody have the statistics? What's been happening in that area? Companies, certainly private equity firms are taking companies private. Companies are taking themselves private. mean, this is it's something you guys don't ever talk about, is it?
I could certainly get you the statistics simply by looking at the Forms 15 that are filed with the SEC.
But you don't have
that isn't even remotely close to what we're talking about.
I guess what I'd say, Ed, is that most of the private equity that in the technology arena is pretty large cap, and it wants to buy the Philips semiconductors and so on. Right now, in the NASDAQ world, we're having many sectors evaluations that are pretty low, which is why you hear about Yahoo potentially being taken private. So there is some of that activity, but the problem is, for many of the smaller companies, and let's define those as sub $500 million market cap, is it doesn't really, it's not a great path to do it. I think there's more consideration for that, but historically there hasn't been that much activity. Most of it you've seen have been a lot of the larger firms doing larger transactions.
Ed, I have a question for you. Can you help the audience here to bridge the gap? Because there is a panel here that talks about going on an IPO and the requirements are quite high. And we see an audience here of entrepreneurs who are building their companies, maybe some of them will mature to a public company, in the next few years. But there is a gap here. Can we use your experience to help the audience here to bridge the gap, to bring them closer to a public company? What do you do in between? What are the options?
Well, I don't quite know how to answer that, except to reflect my own history. I was involved in the company which went public on the over-the-counter market before there was NASDAQ. And we were a $1 million revenues, $50,000 before tax profit. And we went public at some modest but reasonable market cap. And with the stock that resulted from this transaction, we began to acquire other companies for stock. Now, in those bad old days, one didn't have to write off the excessive purchase price over net asset value, so you could continue to acquire companies. Now, the name of this company started life as Tycho Laboratories, is better known as Tycho International, and I can tell you that starting with a $1 million offering on the over-the-counter market, subsequently went to the American exchange and then later to the New York exchange, finished up not very long ago with a market cap of several tens of billions of dollars. So there are ways companies can grow by acquisition. And one thing I would like to point out, since you've given me a chance to say this, I am personally against the idea of Israeli companies being acquired by foreign companies. I think there's a very important number that none of you have mentioned, but I think you should since you're talking about public companies. According to the American Venture Capital Association, 96% of all the job creation in a company occurs after the IPO. Virtually none of it occurs after you've been acquired. You're just there, right? So I'm against the idea of selling companies too soon. I'm against the idea of my good colleague and friend, Danny, and the venture capital dilemma.
It's your fault. It's your industry's fault. I mean,
I don't deny it.
You're the one that require the
No, it's not true. It's absolutely not the sole responsibility. I'm sorry.
It's the VC.
I didn't interrupt you in your thing. You're not allowed to interrupt me in mine. I think that it's very important to grow companies. If a company is going to get itself acquired, let it get itself acquired by a larger Israeli company. Look at Teva. Look what Teva has done. Teva's market cap is greater than that of General Motors, Ford, and Chrysler put together. Close to $50 billion. It's grown by acquisition. In the process, it's maintained its profitability. It's increased its profitability, and all its financial parameters have improved as a result of this. Nice Systems, which used to be next door to me, a little tiny company in the military business, now has a market cap of $2 billion. It acquires Israeli companies. I think that the first charity begins at home. If we want to build an economy, I mean, it was Yossi Vardi who recently pointed out that maybe 30 or 40% of our exports are high-tech product, but only about 7 or 8% of our workforce is employed by the high-tech industry. So I think that, yes, the venture capitalists have something to do with it, but I think the whole question of going public, whatever the difficulties, whatever the obstacles are, it provides a method of producing enough financing to grow the bloody company, and not as a preparatory move to getting it sold quicker. So, Danny?
Ed is our founder at Gemini, and I owe him my career, my job, my life, and everything. And God forbid I sit here on a panel and I would argue with Ed is, I think, unheard of. And here I go. I think Intel has contributed tremendously to Israel, unbelievably to Israel. Okay, and it grew a whole set of people with expertise about how to do business internationally, how business is done in different countries, and made them more professional and better. And we needed Intel here as part of this ecosystem to make us a better industry, and I think to shine in the semiconductor era. Semiconductor era is here, but it's not where the growth is. Growth is somewhere else. And great companies are not here. Facebook is not here. Google is here, but not at the size I think we should have them. And if those companies don't acquire in Israel and build substantial value here in Israel, we will not have talent being grown at the right level to create the next wave of companies. We cannot be a self-sustained industry and get our people being educated at nicer checkpoint. That won't work. So not all companies need to be acquired. I absolutely agree with that. But that's part of what we are. We need to be, the big companies need to be here as part of this ecosystem. Okay? That's why I think these acquisitions are important.
Also, I mean, you're only talking high tech on the medical devices and on pharma. The companies outside, and again, there's Teva, there's Checkpoint, there's Cellcom, there's NICE, there's 10 companies that have achieved the levels you're talking about. 25 companies? I don't doubt it. But there are hundreds of companies that have been acquired by the Ciscos and the 3Ms and the Intels and have served as, they have leveraged what Israel does incredibly well in terms of ingenuity and innovation and new technology.
It provides jobs for 8% of the working population.
I understand, but will you provide enough capital to build big pharma in Israel? I mean, Teva did it, but nobody else has done it in that area.
And I think
nobody else has tried.
Yeah, and just commenting on Teva, and Gary mentioned at the beginning, the relatively low success of IPOs and becoming successful after an IPO. And I think what distinguishes companies like Teva, not only, but like Teva, is the ability to basically utilize synergies and looking at the date of acquisition already on the post-merger integration phase. And not a lot of companies think that. Teva was not always 50 billion. It acquired companies when it was a lot smaller, and if it hadn't had such managerial capabilities and success for the post-merger integration as a small company, it would never become that. So that's part of the thing. So it's also a matter of technology, but it's also a matter of the focus.
The public also ask a few questions here, please, and we have one here.
I'd like to ask a question of Ed, since he's on the panel now. Statistics-wise, Ed, generally, how many of your successes were public? I mean, the exit was an IPO, and how many were actually exits on M&A? Just to get a feel of
We're as bad as the rest of them. I mean, most of them were M&As. And I would have just say, parenthetically, that a lot of the reasons for premature M&As come from the founders of the company, not from the VCs. If a VC is in the last year of a fund and is fundraising, and it's got to show some results to its potential investors, yes, it's very M&A minded. But the founders are the ones where most of the pressure comes from. Guys like you, I mean, who work 7 days a week, God knows how many hours a day, come home one day and find they've got 2 kids they've barely seen before, and stuff like this. This is where the pressure is coming from. And our industry, as an industry, not just the Israeli half of it, has been very bad in providing interim incentives for founders and the people who create companies to allow them to cash in part of their ownership prematurely. One of the golden rules we learned, all the wrong things we learned from Advent International when we started in the venture capital business is, when you raise money, none of it should ever go to the shareholder, to the insiders. None of it. It should all be for building the company. Big mistake. We have at least one case where we got smart, and the company that was offered about $70 million in an M&A transaction, the CEO was very inclined to accept because he had been working extremely long hours. We managed to buy quite a bit of his stock, so he had tangible proof and reward for all the efforts he put into the company, which about a year later was sold for $250 million. Now, I don't think the VC industry has been very smart about this. I think they have been adhering to these principles of exit, and we're accused of this by notable visitors from abroad. But I think it's a mistake, and I don't think it needs to happen. It needs to happen.
I should point out that we represented IVAX in the Teva-IVAX transaction, and we were actually going to buy Teva, but we didn't want to upset Ed.
Please, we have that.
I have a question about the startups. When we start up, we have help from the chief scientist and from incubators. Once you get through with that, then we have to have more help. Nobody tells us how do you get to the IP? How do you get to the next step? How do you get to the place where you're 300 million and all that stuff? It's very nice. You guys are experts, but how do we get from startup that just got an idea, a product, and just barely ready to go to manufacturing and get to your stage?
Danny?
Yeah, oh, that's you, I thought.
Danny, come on, tell me. Tell them how they do it.
No. The question, I'm sorry. This question was how do we go after we raise the initial money? What do we need?
After you get the product ready for market, you haven't raised the money. How do you get to the market? How do you raise the 50 million a year that you want in sales and so forth? There's nobody out there like the chief scientist who is helping us before and advising us.
So I think actually the amount of early stage financing in Israel right now. So I think there's a lot of seed programs that the VCs provide for sure, and I think a lot of the VCs do try to come in with some sort of a help. And I think there's a lot. We're starting to see more and more professional angels that I think do provide some sort of help and alternative in that manner. So. I think if you would look at the late 90s, a lot of angels were people that just had money, okay? And I think now you're starting to see more and more people that came out of the high-tech industry that invest professionally. At an early stage, there's a whole bunch of names. They're called super angels or micro funds or things like that, and I think a lot of them do provide help. The other thing is I think there's a question to ask about the connection of money and help, okay? I know there are a lot of people right now that came out of the VC industry that, for a very minimal level of equity, just provide coaching and help. So raise money from wherever you can raise money, and then go out and get advisory board.
I'll take a risk here, and I'll be blunt, and you forgive me for being blunt here, but nobody will tell you that, because nobody wants to tell you that. Because if you don't know it by yourself, this is the test that you have to pass, if you ask me. If you have an idea and you want to do something with it, many people will give you advice, but eventually you'll have to know the answer yourself. That's the way I feel it. Nobody will come and educate you on how to take the first step. This is what they expect you to do. Take the first step. Go and do it. And if you succeed, welcome to the club. That's the way I see it's being done.
But Yankee, don't you think I think entrepreneurs a lot of times, you do sit, you want someone to bounce the idea off, to be there in the room and say, you know what, I have a meeting with the VC tomorrow and I just have no clue what to do. I just have no clue. And please just let me calm me down, right?
So Danny, I suggest that you talk with Ella and organize the next seminar on that subject. And many advice can be given. I'm not sure that this is the right...
Having said something bad about the VC industry, there are people on this panel who do what you're saying very effectively. First of all, the accounting profession in Israel, PwC, E&Y, focus on small companies to a far greater extent than the big four will focus on them outside Israel, and do adjust their rates and do incubate companies and help them along and show them how to interface with investors. And the one thing the VCs do extraordinarily well is identify great opportunities and provide the capital for them to develop. I mean, and I think that's proven in the success of the Israeli startup industry. So, does that make, are we friends?
Sure. We have time for maybe one or more questions. I know that we had one there, I'm not sure. So, yes, we have one here, and another one. So 3 questions and we'll finish it. Please.
Just to say, I share everything more than others. We in Gilad, we acquired for the first time an American company, and hopefully we can continue. But I want to ask you a late-stage question. Let's say somebody ignores Daniel Cohen's idea and the goal you mentioned, and somehow, okay, Goldman wouldn't talk to you, you're going to talk to Raymond James, they wouldn't take you public, you don't post the board, somebody would take you public, you go public. You grow your business, you fulfill your dreams, everything is fine, you're $100 million, 150 market cap, your analysts go coverage because they move firm, you stay in 100, 150, nobody covers you, zero liquidity in the stock, you're actually public, but you don't have a currency.
Right.
If you look at the Israelis, there are many of them, without mentioning any names, also on the NASDAQ, how do you go outside this vicious circle that you're doing okay, but you're still in a $100 million market cap and nobody covers you and there's no liquidity?
Well, I guess I'd weigh in on that. I mean, the key to all that is what is the fundamentals of the business. We can find some companies here in Israel today that fit that pattern, but they have a growth story and a new product story, and eventually, if there's financial performance, money will follow, research will follow, and so on. So the question is the $100 million company, does it have a systemic issue? In other words, does it have a business model that really doesn't have the ability to break out? If that is indeed the case, the issue that many technology companies make the mistake on is that they hold on too long and that they don't decide to sell or merge or do something. So if you can't break out of that, what I call purgatory, which is you're stuck because you can't generate free cash flow, you don't have that, then I would suggest you figure out a pattern to break out of that, whether that be selling, buying something, doing something different, because you'll probably just continue to atrophy at that rate.
If it doesn't make sense for you to be public after you've gone public, you can go private. You can go dark. You can go under 300 shareholders and stop filing with the SEC and stop incurring all the additional costs, and you can be private again. There is a process for that.
If I understood you, you don't see it as a purgatory. You see that as heaven. It's a micro heaven for you.
I'm not talking about my company, but many companies are good companies. It's just that they came out of favor in NASDAQ because they're only $100 million market.
And they can't get coverage.
They grow 15%, they're profitable, they have good management, they have experience, nobody covers them, and they are actually dead as public companies because nobody want to cover them. It's micro cap, nobody want to invest. Off the record, give you a list of 10 of them, you probably know 20. And you don't have to be delisted.
You're not required to be delisted. You may want to be delisted because you're not getting any benefit from being public. You can't access the markets. You can't use your stock as currency, and you're not. And the analysts aren't covering you because you don't. They get to choose now what to cover, and therefore some boards of directors make decisions to stop incurring the expenses and to go on with life as non-public companies. And then sometimes in 5 years after they've rebuilt the company and not paid $2 million a year to accountants and to lawyers, they think about going public again. there is certainly that avenue to explore.
Thank you. One over there.
So it's going to be a short one. Just my 2 cents for the discussion. I mean, I referred to what was said before. As an entrepreneur for the last couple of years, I think that there's a huge gap between what's called angels, super angels, or whatever, and I raised money from all of them, at least from some of them, to money raised from VCs. And I would expect the government and other bodies here in Israel to do something about it, because it's a huge, huge, and IPOs, that's really nice, but for most of us as entrepreneurs, it's quite a problem.
Okay. I think, Dan, you should address that with the government later on.
We just put our agent in the government.
Good. One over there.
I think maybe out of ignorance, sorry to say it that way, this huge gap that has been described several times could be covered. I think we should give more attention to that. European and markets, etc., that a lot of things are happening there. Not everything is only happening in the States. There are ways much better than we just mentioned. And I think maybe in some way this has to be explored, because I came out of this very sad, because we're talking about a gap that will never be filled.
The Toronto exchange sets itself as an alternative. There are German exchanges and there are Asian exchanges. I don't think any of us, or at least I'm not, I am not an expert in those, but certainly those are alternatives to be considered. The problem with them is many of them haven't been fully tested, and many that have, the Neumarket and the Vancouver Exchange and AIM that came as alternatives turn out to have been dead ends. So you need, I'm not saying don't explore them, I'm just suggesting that I am not, I just can't give advice on them.
But you also heard Ed's story, which was very encouraging. I mean, so you have other avenues.
Can I comment one?
Please.
Yeah, just one thing that was kind of mentioned but should be noted. There's a statistic, which I don't remember the number of, how many acquisitions does a private U.S. company do before an IPO or an M&A, and how many do Israelis do? And I think the gap is tremendous. I think one of the things we as an industry are really bad at is acquiring companies and doing private-to-private acquisitions and doing non-organic growth as a measurement for to reach the next stage. And I think that's something that if potentially we could do, that could be a big driver to get to that big gap that you're talking about.
I think it's an excellent point. I think it will enable us to bridge the gap between the current stage and then being able to go public after you acquired and merged some other international players. It's a great point. But I think we ran out of time. So thank you very much. And Ella, what's next? 30-minute break.